So today I have Omer Chowdhury with me. Many of you will already know Omer from the podcasts that we've done previously. And Omer heads up the fixed income and multi-asset team at Aditum. He's the fund manager of the adventurous and moderate strategies that we run for our clients. And you'll obviously be able to see these live in your portal or live in the Hoxton Wealth app you have with us. And it's essentially a basket mainly of low-cost ETFs that we use to track the market. Welcome back, Omer.
Thank you.
And great to have you here with us again today.
Good to be here.
So obviously we spoke, I think it was the back end of May, start of June last, and we'd obviously were, a lot of it was around tariffs and market turmoil and all the rest of that kind of good stuff. But markets have generally been trending upwards in a positive way. And it seems odd, because obviously we have a lot of, we've had a lot of crazy news over the past few months. We've had more on tariffs. Obviously Trump, it seems like every week is putting his nose in something or the other. Mm-hmm. We saw obviously the US bomb Iran. We've seen Israel and Iran go head to head. Like, there's been a lot. And naturally, if someone said to me, oh, well, I imagine markets to be down, you would, that would be a very valid and rational point, but it hasn't been. We've seen markets obviously trending up. So, what's your take on this, and why do you think markets have reacted the way they have?
Well, the way the markets have behaved is not too unusual if you've looked at past market cycles. I mean, what markets tend to do is quickly price in the worst case scenario, right? In this case, the worst case scenario was Liberation Day, global reciprocal tariffs, very punitive. People got worried, excessive fear. They thought recession was going to be on the cards, right? They priced it in very quickly. From then on, either the worst case happens or it's going to be less than that. In this case, Trump tweeted, 90-day relief, which is coming to an end. And since then, the markets have been like, all right, we're not going to get the worst case, right? So they started buying up stocks. And since then, it's been a straight line up. This is also a reflection of market structure and positioning, right? Not many people have been bullish and long in this whole move up. And when you don't have many people bullish, markets don't really sell off that much. Keep going higher and higher and higher. And a lot of the participation has been from retail as well, right? Obviously, institutions are invested, but retail has been adding a lot of flows into the market. In fact, we have the highest retail participation in US stocks ever in history.
Wow.
Right? So that's been driving stocks up, and ultimately stocks are dependent on how the economy is doing and what earnings are going to be like. And the economy backdrop has been pretty strong. Labor market is pretty tight. The last labor print we got was actually quite alarming, but overall in the past few months, economic data has pointed to the fact that the US economy still is okay and earnings are still pretty much afloat and doing well. So that has helped stocks move higher and higher.
Yeah, it's interesting what you said about retail investors, because we saw lots of memes like buy the dip.
Yeah.
And one of the messages that we put out to investors and on our weekly newsletter is that bad investors panic and sell. Good investors probably sit on their hands and do nothing, but great investors lean in. And actually it looks like the buying the dip was the correct strategy. And it's also really interesting as well because people seem to just kind of ignore the negativity now and just plow in. And in terms of retail inflows, how much of how big an impact that actually is that on let's say the S&P 500?
It's been bigger than it has been in history. And I think retail participation has increased by at least 5-6% in terms of how many households hold US stocks. That might not seem massive, but it is significant. But obviously, it's still a small portion compared to the institutional flows. And institutions, I think a lot of them got out and didn't get back in. And now they're seeing that markets have, kind of calmed down. Earnings are pretty good. The whole AI trend and tech stocks are still carrying markets higher. Now they're coming back into the market. So typically you'll see a point when, markets do a V-shaped recovery like they have, and it's been incredible. Then everyone gets bullish all of a sudden. When everyone gets bullish again, that's when I start to worry. Like, okay, now markets can tip over on any bad news that comes down. And for me, the bad news is going to be a drastic slowdown in the economy. Yeah. Right? Or earnings really, getting downgraded massively. We're not there yet at all. We have to see the implications of tariffs, and the tariff picture is still not very clear. It's clearer than it was in April, but we still have some work to be done to see how we end up. And I think the important thing to know over here regarding tariffs is that the average tariff rate will be in the high teens, probably. We're not sure yet. That's different from our view a few months ago when we thought it was going to be low teens. Either of those cases is higher than last year when it was 2.53%. So there's going to be some impact where and when, we still have to wait and see from the economic data.
Yeah, it's interesting, isn't it? And I think, you touched on it there, is that we haven't seen earnings be impacted by the tariffs yet. So, from all the information that we've received so far, big companies' earnings have been released for half year and quarter end. All seem to be relatively okay. There was no major shocks, was there, really?
No, I think there were some downgrades that happened. So beating those estimates was pretty easy. The bar was low.
Yeah.
But I think we still need to wait a couple of quarters to see the full implication of tariffs coming into, earnings, for example, and the economy. And I think, certain corporates will be able to absorb that, right? Certain will pass it on to the customer, and others will have to probably lay off more workers to actually adjust to that. So we'll have to see how that pans out. But either way, the consumer is going to be on a weaker footing, higher prices. And we're already coming into an environment where consumer strength was going down. And then, layoffs are probably going to increase as well. We're seeing that happening. So the last labor market print with excessive downward revisions was maybe the first kind of indicator that, okay, we're going into a weaker environment with regards to the labor market, but we still have to wait and see a couple more prints, see how that pans out.
Yeah, because we saw obviously Donald Trump come in, and I think he's tried to sack the person responsible for the data, which is also interesting. And I suppose that also kind of feeds into his overall impact on the US economy and US, what should technically be independent institutions. In particular, the Fed. We've obviously seen him, attack Jerome Powell.
Yeah.
I think when they were walking around the Fed's new building, he was kind of making snide remarks and putting him under a bit of pressure. How did the market react to that? Because they reacted really negatively, didn't they? And then he kind of backtracked and then
Yeah, I think when this first erupted, this kind of tension between Powell and Trump, it was actually back in April, the first time we talked about it. And that's when the market reacted the most negatively to that. I remember when we had that massive one-day rally, S&P up 10%. The next day we gave half of that back on this news that, Trump is having a go at Powell.
Yeah.
Since then, the markets tend to kind of forget something that's being repeated, and they don't see any end to it, right? So maybe these are just threats. Maybe he's bluffing. The markets are like, okay, we're over this. So I think there could be a case where he gets removed in May as Fed chair, and Trump appoints one of his guys, or ladies, and in his place. And, at that point, I think they would be more leaning towards a dovish policy, right? The fear is that they might get over dovish, means they might overcut, in which case inflation expectations could go up as well. But I think we're heading to an environment where I think the interest rate environment looks like it might start coming, down, interest rates. And I think the last labor market report was first indication of that, we might head to an environment where policy might start loosening up again.
Yeah.
So,
well, that's ultimately what Trump wants, isn't it? Where he wants to see interest rates get cut. And obviously we've been so used to interest rates around that 4 to 5% mark for a while now. It'll probably become a real welcome relief for investors and also for the general public, because I think it's it's important to know. I think something like 50% of US households are invested in the stock market, but nearly 100% of US households have some form of debt.
Absolutely.
Which interest rate affects.
Absolutely.
So actually interest rates are a far greater boat swinger than the stock market's potentially doing really well.
It should be. And, this whole move up that we've seen since April hasn't been because of a Fed put, as opposed to previous market bounces where, the Fed came in and saved the markets. This has been a Trump put.
Yeah.
Now we're getting into an environment where the Fed put might actually take over. So stocks are enjoying an environment where good news is good news and bad news might be good news as well, right? So if the economy starts to falter, they'll be like, oh, we're going to get cuts. So stocks can keep on rallying, right? So we're heading into that environment. And household debt is kind of at all-time highs in a sense, and credit card delinquencies are rising as well. So interest rates coming down will be some relief to the consumer and the housing market as well. Yeah,
it'd be interesting to see how it stimulates the economy as well.
Absolutely.
If it does, and what happens there. US government debt, that's been another headline that we've seen over the past few weeks, months. I kind of get lost with it all now because there's so much that comes out. But, they're saying that is increasing at an alarming rate. And then we saw the big, beautiful bill get introduced, which again is more pressure on it. Do you see government debt being a real issue in the US, and do you see markets responding negatively to it? Because at the moment it feels like they just kind of ignore it and it doesn't really matter to them.
I think when there's nothing else going around, they focus on it, and it leaves the center stage and comes back. And I think this problem is going to be, in the background, perpetually almost, right? Because the debt problem is very hard to solve. Right? How do you do it? You can't cut spending because you're supporting the older population, and you have to keep on raising new debt to finance older debt, right? Refinance it. So markets are worried about it. Is it going to break the system? I'm not sure yet. And one of the indicators that we look at are treasury auctions to see how they're going. And so far, there's been a couple of auctions that were a bit worrying, but overall, it's been pretty smooth. And, treasury issuance has been absorbed pretty well, even by foreign bidders in international markets. So as long as that remains intact, I think the US can kind of keep on doing what it's doing. There's really no other choice, right? They have about $8 trillion maturing this year on the short end that has to be refinanced. Refinancing at current rates is going to be quite expensive. Your interest expense will go up by 50% to 1.5 trillion. That's why Trump wants lower rates, one of the reasons, right? So whether it gets there or not, we have to wait and see. But, the debt problem is a problem, and markets are going to keep, overall yields, higher than they were in history because of the fiscal premium. But does it break the system? I don't know yet. We have to wait and see how this whole thing plays out.
Yeah, it'll be interesting for sure. And I think it'll be a welcome relief for people that are investing in fixed income as well when it does start to come down. Because we obviously had 22, 23, which were bad for fixed income in terms of the secondary market prices of the fixed income investments that our clients would typically invest in, being it more long dated. And, we've kind of been saying to them, hold on to this stuff because it hasn't produced an amazing return.
No, it's been range bound.
Exactly.
More painful than rewarding.
Exactly.
I would say.
But over the longer term, there is this whole argument for holding fixed income. And initially what we would typically do is hold fixed income for stability in the portfolio, but it's obviously not acted like that over the past few years, which people remember. So I'm hoping that interest rates drop selfishly so we can start to see some positive returns in the portfolio and get a bit of a kicker for that. Because at the moment, it's kind of been a bit of a dud asset.
Yeah, if you look at the 10-year, it's been range bound. It was 4.2 to 4.5, pretty much the whole year. On Friday, after the jobs report, we saw it drop quite sharply. And I think from a technical point of view, I think we're starting to get a bit of a breakdown to the downside. And that will be catalyzed by the fact that, now two rate cuts are fully priced into the market. That doesn't mean they can't be priced out. We have to wait for one more jobs print to come out before the September Fed meeting. But we're heading into an environment where, maybe we get a Trump candidate as Fed chair. Yeah. Economy's starting to weaken a little bit. Interest rates will come down. We might get that move down in yields. And that will kick bond prices higher. Yeah. Right. But I think overall, yields are going to be in a higher place than they have been in historic times. We won't go back to zero levels. No. I think maybe the 10-year potentially goes down max 100 basis points from here. At that point, I would probably lock in some profits if you're holding longer-term bonds.
You don't think it's going to go kind of below 300 basis points in total?
It depends on how much the economy actually weakens, if it does. But overall, I think that with this whole fiscal problem that's coming on, like we talked about in the debt issues, I think investors are going to be demanding higher premium in the long end of the curve, going forward.
Yeah, it's interesting, isn't it? And I think it's something that a lot of people look at. And again, income received from this. Obviously, we have two funds. Obviously, we have two sides of this in the portfolio. We have the short-term liquidity fund, which is really short-dated. Yeah. And actually, we were moving people in who had near-term cash drawdowns that they needed, so you wouldn't get the volatility. Yeah. But you've actually achieved a really nice yield on that. Yeah. So that's been
pretty good.
And then obviously in the adventurous and moderate portfolios, we hold slightly longer dated fixed income, and we've not quite seen the great returns that we would have hoped from that part of the portion. But again, it's still an important asset class to hold and to make.
Absolutely. You want a balanced portfolio. And in like the moderate fund, for example, now we have a pretty decent balance between stocks, bonds, and gold flow, right? And, a day like yesterday's has been great for the portfolio. Stocks up. Yeah. Bond prices up, gold up. Yeah. You don't get those days pretty often, right? So, today's NAV will probably reflect that, and it'll probably be pretty good. But, overall, we try to maintain kind of more of a balanced approach, not put our eggs in one basket. Even in the equity portion, we're more diversified globally now. We have, a slight overweight in Europe. We have some Japan, a bit of China and India. And the fixed income, we've actually reduced our duration overall because the volatility has been too much. And we're just waiting to see how this whole, yield play kind of works out and how the economy kind of evolves going forward before we start to add back to that. But we've come more in line with the benchmark when it comes to duration.
Yeah.
So not too risky as we were in the past few months.
Yeah. And it's an interesting point on gold, and we'll come back to that in a minute, because again, that's been pretty flat since we last spoke. But, what hasn't, equity markets, like we said, there was a 2% drop on Friday and then pretty much all made up again yesterday.
Yeah.
Like, why do we see such, given the fact that we know a lot of Trump, what he's saying is posturing, and given the fact that, we kind of expect it to jump back up, why is there such sharp reactions?
So I think that the down moves happened because of this kind of negative jobs report that came. So the initial reaction was, yields lower, stocks lower as well, right? But also Amazon reported some numbers which the market thought weren't as good as they wanted, even though they're pretty good numbers. Their cloud revenue increased by 17%. Microsoft's was through the roof, right? So Amazon was down, the jobs report came out. It was just kind of like the perfect environment for stocks to sell off a little bit. When you've gone up so much, a 3% down move, it's not a big deal, right?
Yeah.
And then yesterday, dip buyers came in and bought up again, right? Quite aggressively, right? We had a couple of good earnings reports from Palantir. There's some news around Tesla, not fundamentally important. That drove markets higher, which shows you that buy the dip mentality is still very much alive.
Yeah.
And people want to own stocks going forward. And I think the outlook for earnings still looks pretty rosy. Again, we have to see how tariffs kind of affect that or not. But I think at this level, people are still pretty positive on stocks, which is, like you said, it's kind of surprising because the multiples pretty high. We're trading at 25 times earnings on the S&P 500, right? Historically, that's very high. So, further room to the upside gets capped. But I think that, the sectors that are driving US stocks higher, the 10, 12 companies are reporting some very, very decent numbers and strong growth, and people want to own that.
Yeah. Yeah, it's interesting still how those top 10 stocks move the market an insane amount. I forget how much the percentage is that's weighted to those, but
it's pretty high now. It's one of the highest it's been. It's reached about 32%.
That's mad.
So 10 stocks are driving 32% of S&P returns.
That's mad.
Yeah, that can be worrying.
Yeah.
So you have to watch those 10 stocks very closely, right? See what they're doing. But they're driving, the future global economy. Right?
Yeah.
They're the stocks, technology, and AI. And I think we're heading into a world where AI is getting adopted pretty quickly, maybe faster than people think. And those are the companies that are catering to it, right? If you look at NVIDIA, it's just a sheer monopoly.
Yeah.
In GPU chips. That's not going to last forever, but right now, people are still buying their chips, and that demand is pretty strong, and they're posting great numbers.
It feels like they've got quite a big moat around their, kind of their castle as well, doesn't it? Like it seems to be very hard for others to actually get in and be able to push forward and compete against them. I know obviously they've started now selling chips back into China, and then they've kind of trying to...
The old generation chips are being allowed. They say it's interesting. They said for competitors to catch up to NVIDIA, it would take maybe 10 years.
Wow.
If NVIDIA was run with complete incompetence every single day for the next 10 years. That just shows you how far ahead they are.
And we know the CEO is definitely not incompetent.
Definitely not.
He's an interesting guy as well. I actually read his book recently. It's very, very interesting on how they built the company up from literally nothing.
Fascinating. Yeah. Very cool stuff.
Really, really interesting story. Okay, so let's go back onto gold then. So something a bit more kind of historic. There's obviously, we've talked about it before. There's a lot of famous investors that don't like gold. Obviously, we have a part in the portfolio, and it's actually proved to be a really good hedge. We obviously saw some great gains from that over the April period when we saw markets dip and people flock to it. It's been pretty mute. Again, we saw it kind of tick upwards again start this week. Any thoughts on gold in general, and where's the place for that in our portfolios?
So we have about a 5% position in each fund, which is pretty. I think it's a good balance, right? And gold has had a tremendous 2-year run, right? It's up this year alone it's up about 26%. Last year up similar. So getting a multi-week consolidation like we're seeing right now is not abnormal at all. It's quite normal. And it's quite healthy actually. So technically, if you look at the chart of gold, it's looking very bullish, right? And there's different factors that drive gold in a specific month, right? Overall, there's been strong demand factors. Central banks buying gold to diversify their reserves, institutions buying gold, retail jumping on the bandwagon. But recently, it's been more correlated to the dollar. So every time dollar actually spikes, gold has come down. When dollar drops like it did on Friday, gold starts going up. The bottom of this range is 3,200. The top is about 34, 34.50. and I think it's going to break to the upside. We might have one more, leg up.
Yeah.
And everyone talks about, it's overvalued, it's overvalued. How do you really know, right? It's hard to find a fair value for gold. We just look at the fact that, if there are people still buying gold, especially central banks, this trend is going to continue. So we don't want to eliminate it from the portfolio. It does provide some sort of a hedge, but we also don't want to be overexposed to it.
Yeah. And we saw kind of a bigger jump earlier on, I think it was maybe June time, correct me if I'm wrong, when China allowed their insurers to start buying gold as well, didn't we? We saw that kind of tick up. So it is a limited resource. There's not infinite amounts of it. So, I suppose demand will always drive that.
Yeah, I think the trend around diversification of reserves is very real, and it's going to be an ongoing thing. People want to diversify away from the dollar. Dollar will remain king, but you can't have everything in dollars, right? So people get into euros, maybe Chinese currency, other currencies as well, and gold is a form of currency for them. So I think that trend probably will continue. And I think that the recent or inaction in gold that we haven't seen is actually pretty good, right? When things keep going up in a straight line and go parabolic, there is a chance that it can fall pretty fast as well. So we've seen gold go sideways for a couple of months now, 3 months. I think that's a good indication that it wants to consolidate and maybe go higher.
Yeah, interesting. We shall see how it goes. But I think the key is, as we always say as well, is remaining invested over time as well. And I think what's really interesting is even with all this turbulence, when we say we take defensive positions, it might mean that we're just not as overweight in stocks as we might be. But the key is the fund is remaining invested.
Absolutely.
Which ultimately is our message to our investors. It is about remaining invested and not making short, sharp decisions. You obviously need to plan any withdrawals and make sure that you have them invested, but in assets that are probably less volatile and can cover it. But, ultimately the fund is invested at all points, isn't it?
Right, it is. And that's a very important point. It's important to remain invested. And it's not a 1 or 0 game, right? It's not like you're out of the market or fully in, right? So it's about how much you want to be in the market at any given time according to what's going on, right? So if you just bought the S&P 500 ETF 5 years ago and sat on it and did nothing, you did well, right? But data firmly confirms that if you had missed out, let's say, the 10 worst months, then you had been properly positioned for the 10 best months, your returns were significantly higher than just holding it, right? And that's the value add that we bring it, right? We're actively managing these funds. There's a dynamic asset allocation model, and we move around the weight. So we can go underweight stocks, probably put something more safe like gold or bonds when we need to, and then move out of that back into stocks. And we've been doing that quite actively. And, that does end up producing returns which might be a bit superior to just holding on to an ETF and riding the whole wave. But it's important to stay invested, and times like these prove that, right? You had this major fear in April that the world's going to blow up, policy upheaval, everything, and then we had one of the sharpest V-shaped bounces that we've seen in history. And I'm sure a lot of investors are probably kicking themselves for kind of hitting out at the bottom, and that's typical. So it's important to keep some skin in the game, but it's important to be active about your investments.
Yeah, it's active in the allocation, isn't it? I think is the key. And what we're not trying to do is pick individual companies. We're trying to pick asset classes that we think will perform better in slightly more turbulent times. And it's very difficult to make those changes quickly as a normal retail investor as well. Whereas obviously you guys are sat there all day, every day, monitoring what's going on. Obviously I've stolen you for a bit today, but
all day and all night, around the clock, actually.
Exactly. So, we're in safe hands. But, we appreciate that it's all well and good for us saying this as it is. And obviously, firstly, thank you very much, Omer, for coming down today. And everyone found that the update is per normal useful. But yeah, if you are concerned about your portfolio and want to talk to us, obviously, we encourage you to contact your advisor. Or we've set up some new client service information and details that you can contact us. You can contact us on. So the email is client.services@hoxtonwealth.com. We've also got a dedicated WhatsApp number now for our clients to be able to reach out. Obviously, we appreciate that email is not the form of communication that everyone wants to communicate on. And the global number for that is +44 7384 100 200. That's +44 7384 100 200. Or what we'll do is we'll put a QR code at the end of this video that you can scan. And you can chat to one of our client services team. But again, thanks very much to Omer for coming down.
Thanks for having me.
Great. I hope we found that useful. And I hope to see you soon. Thanks very much.